Well, good morning, everybody. I'll make it dead on 10:30, so let's get started. Welcome to our webinar today, which is all about tips for the tax year end, which is fast approaching on the 5th of April. For those of you that have been to our webinars before, you'll know that we do offer the opportunity for a Q&A session at the end of every webinar. We're planning to do that again today. If you're familiar with Zoom, on your toolbar, you'll see the option for Q&A. If you just click on that, it will open up a panel which will allow you to put your questions forward as we go along today. And Pete will attempt to answer as many of those live as possible before we finish. So we're scheduled for 45 minutes today. And what I'm now going to do is hand you over to Peter Squire, Director here at AGS, who's going to conduct the presentation. And I'll see you back at the end for the question session. So over to you, please, Pete.
Thanks, Joe. And I'll be doing my Chris Whitty this morning, asking Joe to change the slides, being as I haven't got control of it. But yes, it all felt a bit more normal this morning. Just as an introduction, I got up at the usual time, put a suit on for the first time in months, and then fought through the school traffic. So yes, maybe things are getting more back to normal. I've had the jab anyway, which was more than 3 weeks ago, so I should be 90% covered. And I have to say the whole process was really easy and so well run. In fact, it took me 8 minutes from getting on the car park to having the jab and going home. Unfortunately, my wife had one at the weekend, which took 2 hours. So I would recommend don't have it at the weekend, have it in the week. But the vaccine rollout seems to be going fantastically. So maybe we'll get a bit more back to normal. I've actually come into the office here to do the Zoom meeting, as you'll see. So I'm not breaking any rules, purely because I can't work from home because I have 2 daughters who have lots of packages delivered to the house and 2 dogs that love people to come to the door. So I thought it much better than me having to mute all the time to do it from the office. So yeah, the presentation may not be quite as long as we thought because there are less changes than we thought on the budget. But I do apologise if I repeat myself as well, because a lot of these taxes interact and it can be quite complicated at times. But anyway, looking at the planning for this year, now the end of March, 5th of April is approaching fast. And it's just the time of year when, if you haven't already done, companies should be looking at their management accounts and forecasts and seeing what they're going to be doing for the end of the year and start tax planning now. You know, it's a good chance to look at your pensions. I mean, pensions is a fantastic tax saving tool. It's becoming more and more prevalent. And really, before the end of your year, you should be looking to have made those contributions into the pension. Otherwise, it's not tax relievable and you lose your allowance for that year on the pensions. You can go back 3 years and mop those up, but it's really important that you get them paid before the year end to get them tax relieved. So really, that needs doing before the end of your year. So now's the time to look at that. And with the clock ticking and with potential tax bills going up in the future, just got to make sure we use up all your allowances for each tax year as soon as we can. So if we could have the next slide, please, Joe. Business tax. Now, lots to look at here. As far as how do you set up the way you're paid. Lots of people will use up their basic rate allowance, 12,500, have that in salary because otherwise you could lose that. So that's the first thing. Make sure you're using up your basic rate allowance, which is only slightly increased and is going to be fixed now up until 2026. So make sure you're doing that. Dividends. As long as you've got the profits in there or you've got reserves, you can pay dividends. So use the £2,000 allowance. That's vital. It's at least 2,000. And a pure basic rate, you only pay 7.5% tax on dividends at the moment. Chancellor is looking at maybe increasing that. So make the most of that now. You use that allowance up at least to the basic rate. And you certainly don't want to be going over into the high rates over £100,000 worth of income. So we always look at our clients and try to keep them below that, if not below the 50,000. But that's something else we'll come on to. with how can you improve that, maybe looking at spouses and using their exemptions as well, doubling up on the tax relief. Corporation tax, well, when you're looking at your year end, you should be taking lots of details into account. Looking at your stock, is there any slow moving stock, obsolete stock? Are there any rework reserves you've got to look at? You might be able to look at last year and thinking, actually, yeah, I did a lot of rework that was for the previous year. Warranty claims, all this sort of thing. Those can be reserved in as well. If that's what we did last year, we're likely to do that again. So do a reserve at the end of the year to reduce your tax. Bad debt reserves, go through your debtors. Are there any likely bad debts? You can reserve those in at the year end. Bonuses, if you're going to pay bonuses for the year, you might pay them after date because you want to see the results, but you can reserve those bonuses again back into the previous year and make sure you don't miss that. And capital allowances, again, look at your capital allowances. I always say make capital purchases on a commercial basis. Never do capital purchases purely for tax reasons. But if you're looking at making a commercial purchase, you might want to look at doing it in the next few months. You want to look at doing it before the year end. Get the full capital allowances. It's up to £1 million at the moment. And he's going to be up to £1 million up until the end of December of this year. So then it goes down to 200,000. So just look at that and look at the timing of any capital purchases. See if you want to do it before the year end or after. Again, we can take that into account with what's happened in the budget, which I'll come on to a bit later on. Capital gains tax, again, has been frozen. That was one of the big areas that the Chancellor was supposed to be looking at, capital gains tax. Everyone was fearing that, and lots of people tried to get all their capital gains tax in on entrepreneurs relief before he stood up. So there was lots of activity going on before that. But in the end, he hasn't changed anything other than just freezing the allowance at 12,300. So again, look at using that up. You lose that each year. So if you don't use it this year, you don't get it next year. So use it up. And also the entrepreneurs relief is still at 10%. So it's still very worthwhile to use that. And if you're looking at selling the business, make the most of it. I mean, it has been reduced down now from 10 million to 1 million. But for most small businesses, that 1 million at 10% is vital, and use it. Now, again, it was an area that we thought the Chancellor would look at this time. He will be looking at it in future years. So just bear that in mind when planning ahead. Yeah, if you could have the next slide, please, Joe. In corporations, again, he has mentioned, the Chancellor, looking at national insurance on self-employed. So he may well look to increase national insurance, hence making corporation look a bit more attractive. Something to bear in mind, if you're getting up to that above the basic rate of tax, it might be worth incorporating and being able to delay some of those profits and being taxed at the higher rates, spreading them over the next few years, using up your £2,000 dividend allowance. And again, looking at spouses, how can we split it between the two? So lots to look at on incorporation and could still well be worthwhile. Capital allowances, yes, in the budget, he's come up with 130% tax relief on new qualifying capital allowances. Now, there's 100% at the moment. We're not quite sure how this is going to interact at the moment. We're waiting for further advice from HMRC, but that's very attractive. You know, after the 1st of April, again, this is all about timing, 100% before, after the 1st of April, we get 130%, but you might want to use up that 100% in the previous tax year. So again, lots of areas to look at, and you know, that's 130%, not quite sure where it's come from, but I think he's trying to get people to invest in new equipment. Maybe he sees that as an area to do it, and that's just for the next 2 years before corporation tax kicks in. So yeah, he's thinking that all these companies are sitting on lots of money and want to invest in capital. Again, I would never do investment in capital items just for tax reasons. They've got to be for a commercial reason. They've got to earn you more profit in your business. So, improve efficiencies, make you more profitable, improve your GP, all that sort of thing. So, yeah, I'm not quite sure how much use that will be at the moment, especially as businesses are struggling through the moment and have probably got, a lot of losses maybe to look at. But it's something that I think he's trying to get people to release the purse strings and start to invest. We'll see how that develops over the next couple of years. Another big area, research and development tax credits. I think there's a lot being underutilized on this. So 5.1 billion last year, but there are still a lot of companies that I talk to and say, well, I don't think that's research and development. And we go through the process and we talk about what they're doing. And actually it turns out that it is. And again, that can give you a lot of tax relief on those research and development costs. We have just as an example, got a tooling company who deal with a lot of motor manufacturers, and they'll get a tool come in and basically just doesn't work. It doesn't do what the manufacturer wants it to do. So they have to adapt it. They have to go through all the CAD drawings, change it, make it work. That can get research and development. So not all of them, but the vast majority can get research and development. So again, don't always assume it doesn't apply. It's always best to have a look at it, have a chat about it and see if it does. We use some experts to review our research and development who are ex-inspectors who used to look after the research and development HMRC. So they know exactly what they're looking for. So we know when they review it, then yeah, this is going to be right. We know this is going to get through because HMRC are looking at research and development just to make sure that there aren't too many bogus claims, because there have been some companies in the past that have certainly made some claims which they haven't turned out to be quite correct, and there are some court cases ongoing at the moment. So that's where we like the backup of having this ex-HMRC inspector who reviews our research and development claims. Therefore, we know he's going to be defending them, and he wouldn't put anything through that he's not comfortable with. We've talked about the profit extraction. Do you use up your personal allowance? Do you go up to the lower rates? Do you not go into the over 100,000, 100 to 125,000 exorbitant tax rates? Don't go over 100,000. So do some planning on that. Use your director's loan accounts. Look at all these areas. What can the business afford to pay? But bear that in mind. Once you don't use that personal allowance, and some people don't use the personal allowance, or the lower rate, you lose it for next year. So why not have a look at it and maybe have some dividends at the lower rate, 7.5%, put it on your director's loan account. You can have the money out later, but use that lower rate up now. Again, a lot of people miss this, and it's really good to sit down, have a look at it, look at your management accounts, look at your forecasts, see where you're going. Can we afford to do it? Can we put it through? This is the implications on your personal tax. There's so much you can do in this area that, but you need to do it before the year end to know exactly where you're going. So again, it sounds easy, but it's not. There can be so many areas that come into it. And then there are tax efficient business benefits. We're all looking at electric cars now, or hybrids. So electric cars are very beneficial as far as BIK is concerned at the moment at 0%. Okay, it's going to go up to 1% and 2%, but at the moment, I know a number of clients now are looking to change to electric cars. So, and you can plug it in at the business and it doesn't cost you. Business can pay for the electricity. So again, more efficient planning on business benefits. So just bear that in mind. Can I have the next slide, please, Chair? Right, yes, personal tax. Again, we've talked about salaries. We've talked about using up your personal allowance. We've talked about the basic rate tax bands and the higher rate tax bands. Again, we don't want to go over that £100,000 level because you really are into super taxes then. And I've mentioned it before, using your spouse. if your spouse has got some shares in the business, they can have part of the dividends. And this is one way we can use to get you below that 100,000. You certainly don't want to be in those higher rates. And we have a number of clients that are husband and wives who have both got shares in the business, both work in the business, and we use both their allowances. A lot of them only go up to the basic rate of tax, so they're paying, less than 20% tax across the whole spectrum, and yet they're having £100,000 worth of income at very low rates. So again, really worth thinking about. And of course, you've got two lots of capital gains tax allowances, 12,300 times 2 if you come to sell the business or sell part of the shares, and you get the 10%. You've each got £1 million. So again, really something to look at on spousal transfers and using them up. Again, capital gains in other areas where you can pass on assets to them and they can sell and then use the 12,300 allowance. There are a number of areas, again, very close, looking at all your assets and how they're distributed and what income you get off them and what income you're going to get in the future and when do you want to sell them. I've done a bit of a case study at the end, which will show you how all this can work together at a level of, spouses working together. So, again, a wonderful area for tax planning. Then you've got looking at maybe exchanging part of your salary. As I say, I've mentioned it before, pension contributions, huge area. Part exchange some of your salary and put it into pension. Tax relief in the company, tax-free in your pension. It grows tax-free in that wrapper, inheritance tax-free. If anything happens to you, the pension, that will go to your beneficiaries. So again, a huge area for tax planning. And we work with IFAs who do our own pensions. And we're always looking to maximise people's pension contributions up to the 40,000 each year to make that work, because it really can. And as I said, I think the case study will show that, how it can work. But that is really one of the biggest areas. There are share schemes as well, which you can do, have benefits on. But again, I really think pensions are one of the big areas. Next slide, please, Joe. Inheritance tax. Again, he hasn't changed any of the bands here. So, your nil rate band is still at 325,000 each, which for a couple, 650,000. And the residence nil rate band is still 175,000. So if you've got an expensive house up to £1 million, you can get £1 million in inherited tax relief. Not quite as simple as that. And you have to look at certain limits and certain rules. But if you're leaving your house to your spouse and then on to your children, then yes, you could well get £1 million. But again, each one needs looking at. There's a £2 million limit you have to be careful of. If your assets are worth more than 2 million, then yes, your allowance gets reduced by £1 for every £2 over. So you just have to be, again, careful of that and a bit of planning. You might want to give some cash away during your lifetime to reduce you down to get you below this. Charitable and personal gifts. If you give more than 10% of your net estate to charity, your tax comes down to 40% to 36%. Again, something else to look at and bear in mind what's in your will. You really need to update your wills regularly. The rules are changing all the time, and who your beneficiaries are and where you want the money to go. So again, we work with people who look at wills and lots of tax planning on inheritance tax to make sure that you're making the most of your estate. None of us want to pay too much tax and really hand it on to our children or other beneficiaries and giving them a huge tax bill. That's just, it's just in our DNA. We don't want to pay tax. Again, pensions are a wonderful inheritance tax planning tool. They can be passed on free of inheritance tax. You just have to make sure you've got the beneficiaries down on your pensions to make sure you've got that updated at all stages. Again, get a good IFA, make sure they work with you on the pensions, and it can be so lucrative if you get this right. It really can. But you've got to get your will done and up to date. Again, I mean, pensions are trust, and we've got trusts down here. So trusts are very complicated and can be very complex. So you really need some advice on trusts. But again, they can be used looking at inheritance tax for leaving assets to family members. So again, I would say that have a review of all your assets, see what you want to do with them, who do you want to leave them to make sure they go to the right places, because you never know. If you haven't got a will, then yes, it could end up somewhere you don't want it to. Just mentioning wills, I always talk about corporate wills. And you say corporate will, well, it's really the shareholders agreement. So all companies should have shareholders agreements to know the rules of what directors can do, what shareholders can do, how they can sell their shares, how do they, retire almost. So that is always good, because I think when it's in black and white, it's less contentious. And we've seen a number of cases where because of not having a shareholders agreement, all sorts of arguments take place, and it can actually bring businesses down. So I think that's another good area. So call it a corporate will. It really shows you what happens in various situations and scenarios, and just make sure that the business is run properly and everybody knows the limits they can go to. So again, I always think that's a very good idea. And cross-option agreements. Have cross-option agreements. Something happens to one of the directors, shareholders. How do their shares get bought? You better have an insurance policy that's part of the cross-option agreement to, give you the money to buy those shares off the family member who's left, who probably doesn't want to be involved in the business and just wants the fair value for the shares. Set the insurance policies up, make sure the cross-option agreement is in place. That money can go directly then to whoever benefits from the will, and that can be inheritance tax-free if it's set up properly. So again, another area to look at. And it sounds, it all sounds very easy to have a limited company, but there are lots of areas to look at just to make sure that it's being run properly and you're not paying excess tax at any stage throughout the whole life cycle of the business. Even income protection insurance. What if one of the directors is off ill? How do you pay them? Look at income protection insurance. It can be very, very good, and they can save you a lot of problems in the future. So you just never know, and you can start them off at quite cheap levels, but they can cover you. Make sure you get the right ones again, but they can cover you for if anything happens. We never know. We can all have illnesses. I had one myself a few years ago, and the income protection insurance was very useful. So again, just look at all these areas. They all tie in to the business, and it's all planning, but you need to do it as soon as possible. So not just for the 5th of April for the year end, but the whole business cycle. Let's look at the whole, as I say, life of the business and you owning the business. Succession planning. Who's going to take over the business? Who are you going to sell it to? How am I going to set up the business to sell? It's always good a few years before you're selling. They always look back at the last 3 years and try and do a value. Well, let's look at maximizing the value of the business. Let's really look at, how can I benefit the most by doing certain things in the business? Trying to get rid of debt in the business. Cash-free, debt-free is a usual thing when you come to sell the business. So they don't want to see debt in it. It'll come off the price that you'll get for the shares. So why would you want to do that? So again, it's all about planning and looking forward. And as I say, it really can benefit the business hugely. Next slide, please, Joe. Pensions. I've gone on a lot about pensions. But as you can see, you can have up to 1.073 million in a pension before you have to pay a lot of tax. So, it's going to catch a few people, but for most of us, we're not going to get to that £1 million pension, so probably won't affect us too much. And you can do some small stakeholder pensions there, 2,880 a year. But really, it's the £40,000 allowance, which if I can go on to the next slide, please, Joe, you can see there, £40,000 allowance each year. Now, if your spouse is in the business as well, then you can put 40,000 each in, which can rapidly grow your pension, which is, again, all tax-free wrapper. And now at 55, you can get your hands on that money, all of it if you want to. But obviously, you wouldn't want to do that because you'll pay lots of higher rate tax, but you can start drawing down on it. So, build your pension up. As I say, I've done a bit of a case study and these are actual clients and what they've done and how they've ended up, they've not got to the £1 million, but they've got to a very healthy stage of pension, and they've used as much of the tax allowances as they can. The higher income, you've got to be careful. The higher income you've got, then it does taper down. You can't put 40,000 a year in again. So this is where, again, looking at planning your income, planning your £100,000, keeping it below the £100,000 level. Sometimes that's just not possible. People want more money, but if you can split it between you and your spouse, you can have 200,000 out and still invest into pensions at the full rate. And you can go back 3 years there. If you haven't used up the allowances for 3 years, you can mop those up. But each year it goes on, go past the 5th of April, you lose one of those 3 years. So again, if there's money floating around, that's a good area to look at. Build up that side of it. Very good tax planning, IHT free, capital gains tax free, growth free in the pension. You get corporation tax relief in the company. I won't apologise for keep going on about it because I don't think enough people actually look at this and make the most out of it. You can, for employees, you can make tax-free pension contributions, which instead of doing bonuses if they want, saves you the national insurance employers, benefits both sides. So again, they can build up their pension, and it's a good way to keep employees in the business. Keep showing them that you're thinking about how you can reward them. And you can go, but as I say, you don't use pension allowances from the previous 2 years. You can mop all those up and do them in one lump sum if you want, if you can afford to. So again, all is not lost. If you haven't used last year's or the years before or the year before that, you can still do it this year before the 5th of April. So again, another area to look at, but pension contributions, they have to be paid before the end of the year. So just again, bear that in mind. You need planning now. Get onto your IFA. This is what I want to pay in. Get it all sorted. Get it paid before the end of the year. Next slide, please, Joe. I'll just touch on some tax-free or tax-efficient investments. I won't go into these too much because we don't really give independent financial advice, and we'll leave that to the IFAs. But just to touch on them, you've got the ISAs. Use up the ISA allowance, 20,000 each year, and you can invest those in all sorts of areas. We're hoping that the Chancellor will simplify ISAs because they can get a bit complicated, but still well worthwhile looking at ISAs, put it in a tax-free wrapper. Share schemes. There are share schemes, EMI schemes, which you can use actually for employees of the company. Get them into a share scheme. It ties them into the business. So they're being rewarded and you're tying them into the business. Maybe looking at succession planning. We've got a number of areas where, yes, people are looking at EMI schemes to reward an employee. So they get the cost now and the base cost. They don't pay any tax until, say, the business is sold, but they'll benefit if the business is sold in the next few years. So again, but that ties them in. If they leave, those options go. So they're unlikely to leave in that time, and they'll want to maximise the value of the business. So again, share options is a good tax planning tool. and business succession planning tool. Venture capital trusts, yeah, you can invest in those and get tax relief. And there are preferential capital gains tax treatments. But again, same with community investments, social enterprise investments. Those again need to be looked at, and really you need to look at that with your IFA along with ourselves, and we can do some joined up writing on that into actually how we link them all together and where all your investments go. Again, with pensions and all these other areas, probably best not to put it all in one basket. Spread it around. And there are life assurance bonds and offshore bonds, again, a bit more specialist, probably going to the areas of the IFAs again on that one. Should I have the next slide, please, Joe? Just on the budget updates, not a lot happened, and you can probably see the deliberate error on that slide. No corporation tax mentioned, which is going to increase in 2023 to 25%. However, I'm not quite sure whether we get, now it's 2 years down the line, whether we actually get there. Corporation tax was supposed to go down to 17%, but it got stuck at 19% and they didn't go ahead with it. I do wonder whether the next 2 years, if the economy improves and he looks at it and there's an election a year later, I do wonder whether he'll bring that 25% down. And although we feel like it's a tax rise, although not for a couple of years, will we feel like it's a tax cut in that couple of years? Don't know. Could be politics being played there, but it certainly won't hit until 2023. And then only for companies making profits over 50K. So if you're under 50K, you only pay 19%. If you're over 250K, you pay the full 25%. If you're in between, then it'll ratchet up, depending on where you are in that gap between the 50 and the 250,000. Again, really good to do some tax planning to make sure you don't pay the high rates of corporation tax, if at all possible. Other areas of the budget, there's a 5% reduction in the VAT rate for hospitality, which has been extended to September 21. A bit like other things in the budget, is extended furlough and all the other areas, costing the taxpayer a lot of money, but it's keeping people in jobs, and he really needs to do this. The VAT rate will increase to 12.5% until April 2022. So he's trying to help out there again on the VAT, get us all out eating in restaurants, etc. And that would be a lovely thing to be able to do, I must admit. Stamp duty land tax holiday has been extended again to 30th of June. It'll then be reduced, the nil rate ban, from 500,000 to 250 from the 1st of July to 30th September. And then we'll go back down to the more normal level of 125,000. And business losses will be extended to not just throwing back 1 year, but 3 years. I presume here he's got in mind people who are making losses at the moment and can try and get some cash back by going back the 3 years to when they were profitable and getting some tax back that way. I think that's what he's trying to do without putting corporation tax up until 2 years' time. Of course, if it might be that some people say, well, those losses, actually, if I carry them forward, and you can carry them forward, I'll actually get a bigger tax relief at 25% in 2023. So again, there needs to be some close planning and looking at how that will affect you. But cash is king, and if you want the cash, then you can go back 3 years and get the corporation tax back that you paid in previous years. So there is a cap of 2 million on that, but that'll only affect really bigger companies and groups of companies, because the bans will be split on that. And then I've just done a case study then, just very quickly, this was a couple who had a limited company, and they owned a business property, and they'd got some money in pensions, and they wanted to put the property into the pensions, and they hadn't got enough in there to buy them. So they actually went and borrowed some money to pay the contributions, mopping up the last 3 years into the pension. The pension then had enough money to buy the property, bought the property, and they paid those loans off. So then now they've got a property in the pension, tax-free. They've got all the tax-free allowance on the money that they've mopped up for the last 3 years, which is 40,000 a year. That company now is or the pension fund is now charging the company rent. So there's 25k rent going into the pension, tax-free, deduction in the company, tax-free in the pension company. They then, over the next 10 years, plan to put as much money as they could into pensions to build it up. So they used, they split their incomes, not to take them into 100,000, they use their 40,000 each. So they put best part of, for the last few years, certainly they put 80,000 a year in pension contributions, and they got 25,000 going in with the rent. So it was 105,000 going in to the pension scheme. Brilliant. They built the pension scheme up to about 1.5 million, including the property at about 300,000. Then sold the business, got the entrepreneurs relief at 10%. They're probably on the income only been paying about 25% tax over all that period. They'd got 100,000 a year going into the pension. That built up to 1.5 million. Sold the business, so they got some cash there, which they only paid 10% on. And by using that cash, they were then getting the state pension at 15,000. They got the rent going into the pension, which they'd use for drawing out at 25k, so it's 40k. And they wanted about £100,000 worth of income. So they'd got 60,000 then, which they funded out of the cash they'd had for selling the business, some cash free in the pension, and some drawing out of the pension. And what they did, really, they got the £100,000 of their income, paying about 10% tax. And it was such good tax planning to get the £100,000 of their income, paying 10% tax, and they weren't biting into the capital in the pension. So that could be left to their beneficiaries in their will, which are all up to date, tax-free. So that's just a little flavour of what can be done if you get your tax planning right. So, yeah, I think that just about brings me to an end for and then we'll see if there's any questions. Joe, have you got the questions there at all?
I do, Pete. I have a couple that have come in already.
Right.
So first one is, how can losses on a limited company be used following the budget?
Right, okay. Normally, as I mentioned, losses can be thrown back 1 year. So if you made profits in the previous year, you can throw those losses back, you can get the tax back at whatever level the losses are. Now you can go back 3 years, because most people find that, okay, losses I've made, I go back 1 year, I was probably making losses then with the way things were going and the way it's hit us. You can now go back a further 2 years. So you can get, some cash relief benefit straight away with making losses, which I think is where the Chancellor's looking at it, with businesses struggling as they are. Let's use those losses up and get some cash back in. And as you say, cash is king in the business.
Okay, thank you. And another question here on this announcement in the budget on capital allowances. So how much tax relief can a company receive on new plant and equipment purchases?
Right, yes, it is not quite clear how this is going to work, but his suggestion is that it'll be 130% of the money you spend on plant and equipment that you'll get tax relief on. Now, up to $1 million, you get 100% on anyway, and then there are certain first-year allowances on other types of assets. So we've got to wait and see how this is all going to hang together, because we're not quite sure whether you use up your 130% allowance first, then go on to the 100%. How does it all work? Because the 100% at £1 million stops at the end of the year, and then it goes down to 200,000. So obviously people are going to want to use 130% allowance, which is there for 2 years. So we need some further guidance off HMRC, which hopefully will come over the next few weeks. So, and that'll be on our mailing letters. So if you look out for those, that should update you on the capital allowances situation.
Okay, lovely. Thanks very much, Pete. Okay, I can't see any more questions. So what we'll do is
pick up my voice then now.
I think you possibly answered them all, Pete. But If there are any more questions, please take the opportunity now to use the Q&A panel. Just while we double check on that, I will say that we have recorded this webinar, so we'll make a copy available on demand on the website later on today. So if there's anything that anybody wants to go back over, then obviously you can go and download the video and watch again. And of course, if you've got any more questions or want to get some planning in place, then please don't hesitate to contact Pete directly at AGS. His contact details are all on the website. So Pete, I can't see any more questions coming through, so we'll close the top at that point. Thank you very much for your presentation.
Yeah, and please contact me if you've got any questions or you want to go through any certain situations you've got yourself. Not a problem. And thank you for attending.
Okay.
Hope you enjoyed it.
Thank you.
Okay, thank you.